the earnings per share, operating margins, ROE, which is return on equity, and then of course there's free cash flow. Does the company have a moat? What is a moat? If you don't know the things that I just mentioned just now, you probably shouldn't be investing in individual stocks right now. Guys, look, there's a lot of people out here who are gambling in the stock market, right? Just hoping that their favorite ticker symbol hits like a lottery scratch-off ticket. It's a gambler's mentality, sort of like you want to hit the numbers, right? But real investors, they're not out here just picking stocks. Real investors are out here buying ownership in real businesses. And if you don't understand the business behind a ticker symbol that you want to purchase as a stock, then what you're doing is you're setting yourself up for mistakes and possibly losing your money. Now listen, this video is about folks who want to get really, really serious about building real wealth, not fake wealth, not hype, not overnight wins, or not get rich quick stuff, but real wealth. Now, I've been invested in the stock market for years, and I hold individual stocks, I hold index funds, I hold ETFs, but over time, I had to sort of shift my mind frame in terms of how I look at the stock market. And so I stopped chasing stocks and chasing ticker symbols and some of these stock tips that we get. And I stopped guessing. And what I started doing was I started studying. I started researching. I started looking at the numbers, looking at the management, right? Looking at industries and sectors. Because once I realized that I'm not just buying a stock, I'm actually buying a piece of a living, breathing business. Everything changed in terms of how I invested. So whether you're a beginner that just started or you're a seasoned investor who's already building a stock portfolio, or you may be one of these advanced investors who just are feeling like you're missing something, this video's for you. So let's jump into it. I want to start with the big three mistakes that most people tend to make. And I say these mistakes with all honesty and truthfulness and humbleness, and I've made these mistakes too, but these are things you got to watch out for that I want to alert you to. First, most people are chasing these ticker symbols, right? They're not chasing value in a company. They're chasing NVDA for NVIDIA, they're chasing AVGO for Broadcom, or they're chasing PLTR for Palantir, TSLA for Tesla. They're just chasing these symbols. But most people can't tell you, what does the company actually do? And how does the company actually make money? Or what is the company's future outcome look like at this point? We got to know this. A stock is not just a symbol. It's a slice of ownership. It's a seat at the table. And you want to know who's cooking your food when you take a seat at the table, right? Who's cooking in the kitchen behind you, right? A lot of people, you're going to sit down at a table, you're going to look at all the wonderful food out there on the table and not think nothing of it and just dive in and start eating. But I want to know who cooked the food, right? Who prepared the meal? Did they wash their hands? What are the ingredients? How was it prepared, right? Like when you go to a potluck, right, you always ask, who made the potato salad? Who made the macaroni and cheese? You kind of want to know who prepared it when you go to a potluck, right? Maybe not so much a restaurant, but if it's potluck and you can ask and you can know, you kind of want to know. Same thing with my stocks. I want to know more than just the ticker symbol or the hype or the article that was written about it. I want to know more. I want to go deeper. I'm putting my hard-earned money into this thing. Something that I sweated for. I sweated for this money. So I want to know more about what it's going into. Another thing that happens is people tend to follow the hype. They don't follow the fundamentals, right? Now listen, Wall Street don't care about your retirement. CNBC, they're not going to pay your mortgage when your mortgage is due. So if you're buying stocks based on the article you read or what you saw on social media or what somebody on the news or on TV said about a stock or some type of tweet on X or Twitter, whatever you want to call it, you're not really investing. What you're doing is simply reacting. See, investing means you have to take your time, do your research, and think about it. Think it through. Most people, they don't buy stocks like that. They buy stocks based on hype. But real investing in real companies, that's going to be boring. I hate to tell you. It ain't going to be fun and hyped. It's going to be boring. It should feel, really investing in companies should almost feel like paint drying almost, right? It's just mundane, basic, to the point, boring stuff, right? It's not like betting on a horse race and you rubbing your hands together and hoping this outcome is going to happen and you hoping and wishing and wishing and hoping. That's not investing. That's gambling. And also this is the third one. Most investors, they don't think like owners. When you shift your mind from being an outside speculator to actually thinking like an owner, everything changes with your investment decisions. I guarantee you. See, owners are going to look at what are the possibilities of long-term returns, right? Are you actually looking at the possibility of long-term returns on the individual stocks that you have right now? An owner cares about leadership, cares about quality of service and quality of products. An owner is looking at customer loyalty. An owner is looking at competitive advantage. An owner is looking at profit margins and the money, right? Now, are you looking at the leadership of all of the stocks that you own? Are you looking at customer loyalty and profit margins? I mean, drop a comment below and let me know if you've ever bought a stock, any stock in your life because somebody else said it was about to explode. Just be honest, right? I know I have. A lot of us, we've all done it. No shame in the game, but we're moving to another level. That's why I'm doing this video, so we can take our investing to another level and not be stuck there doing what everybody else does and then getting the same results everybody else does. We want to get better results. Now, what does it mean to buy a business and not buy a stock? Buy a company and own a company, not just buy a stock. What does that mean? What does it look like? Right, let's go deeper. It really means we gotta look under the hood. And then we got to look under the car. We got to get under it and look at the details and the problems and issues and potential good and bad of a company, right? We got to start asking the question, what does the company sell? How does this company make money? To whom do they sell these products or services to? Is there a demand or a future demand for this product or service that they sell? Or is that demand shrinking? Are they in the process of innovating and being innovative and doing new things? Or are they just existing at this point, right? And then you want to know about the leadership of the company. Who's running the ship, right? Leadership can be everything to a company. Do they have a vision? And what is that vision? Have they communicated that vision with shareholders? Or is this just a leader who reacts to stuff all the time and you see it in the media? And are they well respected? Do you trust their decision making as a leader? Do they have a history of good business acumen and making good business decisions as a leader, right? You want to know all this about the person who's leading the company where you're buying a slice of ownership from, right? It matters more than we think it matters. You also want to be looking, if you're buying a slice of a business, a piece of ownership, you want to be looking at the profitability of this business. So in other words, is the company making money? Right? Or are they on their way to becoming profitable? Is their revenue trend, their top dollar revenue trend, is it going up or going down? How's the company's debt position? Are they in a lot of debt, a little debt? Are they bleeding cash? In other words, when I say bleeding cash, I mean, is the company spending more money than they're actually bringing in and earning, which would result in a fast and quick decrease in their cash reserves. So you also want to be looking at some of these quantitative analysis, some of the money, such as the earnings per share, which is a measure of a company's profitability per share of stock that's outstanding out there. You also want to be looking at operating margins, which is how much profit a company makes for every dollar of sales after you account for the running of the business, right? What it costs to run the business. And then there's, of course, ROE, which is return on equity. This is going to show you how ROE is going to show you how effective a company is using the money invested by its owners, shareholders, in order to generate earnings. And then of course there's free cash flow. This is the money that a company has left over after covering all of its operating expenses, all of its capital expenditures, right? Basically it's the cash. Free cash flow is the cash that's left over that a company can do stuff with, pay down debt, put back into the business, build infrastructure with it, invest with it, or return value to the shareholders, sometimes in the form of dividends, right? That's what free cash flow is good for and important for. The reality is this. What I'm trying to show you, if you don't know the things that I just mentioned just now about the quantitative analysis, the numbers, you probably shouldn't be investing in individual stocks right now until you can start to get a grasp and a handle on some of those things. And it don't have to take like 2 or 3 months for you to understand and learn that stuff. You could buy a book today off of Amazon, have it delivered to your home tomorrow, start reading and understanding, and next week you're ready. Or it could take you 6 months to a year to get ready. But if you don't understand the numbers in terms of evaluating the company that you're trying to own when you buy stock, you probably shouldn't be investing in that company. Guys, if you're getting any value from this video, do me a favor, smash the like button, and most of all, share this video with someone who you know could use this valuable information. Also, feel free to drop me a comment below and let me know your thoughts. Now, let's get back to the video, right? And then another thing you need to do, that's quantitative analysis, but then there's qualitative analysis. Everything other than the money, which, as I said before, was the leadership, but also qualitative analysis is the moats, understanding the company's competitive advantage, if they have one, if they don't have one, why not? And so a moat, right, does the company have a moat? What is a moat? A moat is what protects the company that you're investing in or want to buy stock in. It protects the company from competitors, right? From competition. So you should be strongly considering investing in companies that have a competitive advantage over other people, other companies in their industry. Answer the question, could a startup take their lunch money tomorrow, right? If the answer is no, okay, you good. If the answer is yeah, probably, then maybe that's a company you don't want to buy, right? But big moats equal brand protection. Big moats equal brand power, scalability, customer loyalty, brand recognition, patents, trademarks, ecosystem. Like, that's a big moat, right? When you find a company that has that competitive advantage. Think about NVIDIA. NVIDIA has a moat in the AI space because they control everything from gaming to data centers to semiconductors, et cetera, et cetera. They have a moat in that area of AI right now. Look at Coca-Cola. Coca-Cola has a moat based on its brand recognition worldwide, right? You can go to any country on the planet and buy a Coke or a Coke product, not to mention Coca-Cola's distribution links. What other company has distribution in Peru, Bangladesh, Angola, Iceland, Australia, and Indonesia, and the United States? Like, what other company does that? Very few. So they have a moat. Think about Costco. Costco has a moat based on its unique and effective membership model, where everybody pays a certain amount of money every single year to actually belong to Costco and be able to get the discounts they offer. So these are examples of companies that have strong moats in their industry, right? They've got that strong competitive advantage. Remember, you're buying a business, a company. You're not just buying a stock or a ticker symbol, right? One thing to note here, guys, let me full pause, is this. It takes a lot of work and research to really buy stocks right, the right way. This is the reason why I strongly recommend for new people who are new investors and just getting started and just learning the game of investing in the stock market, I recommend ETFs and index funds, right? For people that don't want to take a whole lot of risk or don't really understand some of the things that it takes to evaluate a company, ETFs and index funds are a nice, solid, low-hanging fruit, easy point of entry into the stock market that most people can really thrive on and understand. And in the meantime, learn some of these things about individual stocks, right? Because with an ETF or an index fund, you're not guessing. You're owning a basket of great businesses that have already been vetted, that are in the basket, that you're buying the whole basket, right? And that's what most investors really want to do. We want to buy a bunch of really good stocks. Well, ETFs and index funds are typically a bunch of really good stocks sitting in a basket, right? But here's what smart investors do. They start with ETFs and index funds because they don't necessarily want to read the earnings reports, the 10Qs and 10Ks. They don't necessarily want to get all into the quantitatives of an individual stock or company, right? They don't really want to listen to the CEO calls. And so they start with the low-cost ETFs and low-cost index funds. They are diversified, they're fairly reliable, and they're more of a passive way to get into this investing game. Now, I know a lot of people that watch this channel are just getting into investing, maybe in your first 2 or 3 or 4 years of investing. So I've personally been using the app called Moo. and I wanted to introduce it to you guys. And this video is sponsored by Moat. It's a super easy and user-friendly investing app. But at the same time, Moat still gives you all of those pro tools. So you got your live market data, you've got your updated investing and market news, and you've got your easy-to-use charts as well on Moat. Now, the best part of using Moat is that new users can get up to 60 free stocks when you open up an account and you make a qualifying deposit. Now, that's actually why I tried it out. Now, I tried it out. I like it. It has a user-friendly interface, easy to understand platform, and therefore, I wanted to introduce it to you. If you're interested in learning more about Moat, do me a favor, click on the first link in the description box below and sign up and get your free stocks today. And let me know if you have any questions. But listen, if you just desperately want to pick individual stocks, I'm good with that, right? I'm not mad at you. Just make sure you do your research and you understand some of the more details and intricate stuff that we're talking about on this video, right? Make sure that you understand that you're buying companies when you buy individual stocks. And so you need to know and fully understand what you're buying and why you're buying it, right? You either use the products, or you like the leadership, or you believe in the mission of the company. You understand how the company makes money, and you understand the industry and what their competitive advantage is, and you also understand their earnings per share, their free cash flow, and their debt position, right? You get all that, you know all that, you understand all that, you research. Cool. Buy the individual stock if you want, if it fits your philosophy in terms of buying individual stocks. And you don't need 50 or 100 stocks in a portfolio. Just 5 or 10 stocks to start is a good starting point for most regular individual investors. I like to put it like this: if you can easily explain a business to a 10-year-old, you understand that business. If you focus on a company's mission, focus on their management, and you're focused on their moat, their competitive advantage, and you understand the money side of it, right? The balance sheet and all the things in the balance sheet, you're good. The mission is the vision. The management is who's in charge. The moat is the competitive advantage. And the money is all that quantitative stuff that I mentioned earlier, right? The boring stuff that you're going to get off the earnings report. Then you're good. Now, my suggestion is also to dollar cost average into individual stocks. Stay away from always trying to buy the dip. I'm good with you buying the dip as long as you buy the dip as a part of your strategy, because you're dollar cost averaging in as well. Because we want to be buying stocks consistently. You'll catch the ups, you'll catch some downs, but ultimately, long term, you're going to come out ahead. Studies show that dollar cost averaging lets you come out ahead. And you might be thinking long term with individual stocks as opposed to day trading or buying it for a while, holding and getting rid of it. You know, when you do that, it can hurt your overall stock performance over a 5, 10, 20-year stretch. As Warren Buffett says, hey, if you're not willing to own a stock and hold a stock for 10 years, you probably shouldn't own it or hold it for 10 minutes. So here's some key takeaways from this video. Stop chasing stocks, stop chasing ticker symbols, and start thinking like an owner, a business owner, because when you buy stocks, you're buying a slice of the company. Study the business, study the company, not just the stock. Use index funds and ETFs to start while you're getting comfortable learning how to evaluate companies. Most people lose in the stock market because they treat it like a casino as opposed to treating it like a classroom, right? So you got to be different than the people who just ride the waves of hype. And you got to ride the waves of research and evaluation. That's why you want to stop picking stocks and start buying companies. That's what everybody gets wrong about this thing. If this video gave you value, do me a favor and hit that like button for me. And just comment, I got value. I offer one-on-one financial mentoring and coaching. Click the link in the description box below and be sure to get your free ebook, The 24 Laws of Money. There's a link to that below as well. Share this video with someone who you know may be looking to invest money in the stock market. And if you want to know exactly what's in my personal stock portfolio right now, exactly what I own, you need to check out this video right here next. Peace.